Well, thanks for coming back, William. We appreciate it.
Well, thank you for having me. I enjoy flying back out here. I mean, I'm hoping we do this every month. You know, it gives me a reason to get out here.
We'll have you as much as we can, buddy. First question, and a question I get asked the most as a realtor is a first-time home buyer program really worth it, and is it easy to get approved?
I think like the last time we said, everyone's situation is different. So it may be worth it for certain buyers. It may not be worth it.
Why would it not be worth it for someone? If they're a first-time home buyer and they can qualify for the program, why wouldn't it be worth it?
It all depends on your a lot of time people use first-time home buyers because they have a problem with the credit,
okay,
right, or the down payments, or they just want a lower interest rate. So the pro of using a first-time home buyer program, the FHA for short, is that the rate's lower. Usually a lot lower.
Significantly?
Depends on the credit, but usually it's significantly lower than the conventional rate.
So let's say if today the rate is 7.25%,
maybe.
Then what is?
I would say 6.5 maybe, or like 6. Yeah, or depending on the situation. But I've seen it.
Okay.
I had a client that they had a horrible credit score.
Yeah.
And if they went conventional, they would have been 7.5% with 2 points. That's 2% costs.
Damn.
Right. But when we switched to FHA, it was 6.125 with no points.
That is incredible.
Yeah. So if you have pretty shaky credit, that might be beneficial to you. Right. So the con is that the FHA is a government program. They charge a 1.75% fee up front to use the program.
Is this a PMI?
No, that's just a fee to use the program right up front. Now the good thing about that though is that you can roll that part into the loan, so it'll be added to that. It's usually about 8,000 extra on top of the fee they charge.
Yeah.
So you just roll it into the loan. So we count that towards the loan. And then also the PMI, the mortgage insurance for FHA is higher.
If you guys don't know what PMI is, that's private mortgage insurance.
Yes, private mortgage
meaning
insurance.
that if you are under 20% on a down payment,
correct,
they charge this PMI because they're like, hey, Justin, if you're only going to put $10,000 down, and I got to give you this $500,000 loan. Okay, these numbers don't really make sense, guys. I'm just throwing out numbers here. But if I'm giving you a $500,000 loan, that's a big risk. I don't know if you can pay that, so I'm going to charge you this insurance in case something were to happen.
I see.
So that's what a PMI is.
Yeah, usually lenders want to see 20% down, but that is not required. That is not required. So
I can tell you right now, most of my clients do not put 20% down.
Do not.
I would say like 2 people that I've worked with can only put 20% down.
Yep.
Everyone else that I've worked with, they're like 10% or under.
Right.
Most of them are at the FHA, 3.5%.
Minimum. Yeah. So minimum down payment for FHA is 3.5%. Now the weird thing is for a regular conventional loan, the minimum is 3%. Right. But if you have good credit, there's no reason, depending on your situation, but if you have good credit, good income, I always recommend going this traditional route. That's because the rate might be a little bit higher, but your PMI is lower.
The PMI is lower, and there's no upfront.
Costs, right? So it might balance out with the rate, or even save more money with the rate, right? Even though the rate's higher, you still save more money monthly, right? Because the insurance for FHA is kind of high. I believe if you're under 10%, it's 0.85%. They add onto monthly, so it can make a difference between conventional maybe $100 if you have good credit, $100 a month on PMI. Right. Versus like $300.
Wow.
One thing that a lot of people get confused with who are just coming into the real estate world is they think 3.5% is the rate that they're getting.
No.
But it's 3.5% down of the purchase price of your home.
Yes.
And so the lowest you can put down is 3.5% on a home, right?
On a FHA.
And there's a limit to it, like $600,000, $700,000, something like that, right?
It all depends.
Where you live?
Yeah, how much there's not really, there is a limit. Conventional, it has to be conventional. It can't be above, it could be above depending on the county, right? Some like let's say LA County, they'll have there's a minimum limit, the maximum limit, and there's a little bit more room that you can go up more.
Yeah, because it costs more.
Yeah, but depending on the area, there could be the maximum. That's it. You can't go past that maximum.
I heard just last week they increased the limits.
They increased the limits in January. Every year they increase the limits.
Oh,
every January they increase the limits.
I see.
Yeah.
Okay. And what is the max you can put down with an FHA?
You can put as much down.
Really?
Want. Yeah. Yeah. You can. But if you can put a lot down, there's no reason why you should go FHA unless you have horrible credit. Right. I mean, if you have like let's see, minimum is like 620 credit score.
Yeah.
I think FHA is like 580. But if you have really, really poor credit, some bad decisions when you're younger, FHA might be the only route. Even though you put a large percentage down, it will help with your monthly because the mortgage insurance will be less because you have to borrow more. You have to borrow less. But it will help you qualify basically.
So
with a better rate.
So you've been a lender for a few years now,
Yep.
and you've helped so many people. Is FHA the most used program?
Lately, yes, because it just helps people. A lot of people now that are there, it's easier for them to get into the house, even though rates are high, but there's less buyers out there. And when the market was hot, these sellers weren't accepting FHA buyers because FHA, although it's beneficial to the buyer, they're a little bit more harder on housing rules like appraisal. Right, appraisal. They have to have their own FHA approved appraisals come out. And it takes longer. Right, there's no quick turnaround on that. It takes long. They have specific guidelines they have to follow. Like I believe we had one with the paint.
Oh my God, this one was horrible. So I had a seller that I was representing, and then we also had a buyer that we're representing because the buyer didn't have an agent and they came in through an open house, and so this was my first time selling a home. With someone who's a buyer's FHA.
Yep.
Now, I deal with FHA buyers all the time. That's my most type of clients that I have just because everyone that follows me on Instagram or knows me are very young. So it makes sense that you guys are first-time home buyers. And so, and I know so many agents that have never done an FHA in their life. And I'm like, what? This is what I mainly do.
Yep.
So, but being on the other side of the listing agent and helping this person sell a home, I learned a lot about the FHA program. So this lady's house, her paint was cracking, chipping. The roof had some shingles that were broken and torn off. And so when the appraiser came, they're like, okay, yeah, this house is pretty good, but the government requires you to repaint the house and fix the shingles on the roof.
Yeah.
And I'm like, oh crap. How am I going to tell the seller that she has to repaint her house in like this week to be on time to close, the deal down?
Yeah.
And so, as a buyer, you're like, this is dope. I get a new painted house. I get new shingles on the roof. I'm down. And the seller, you're just like, why? And so a lot of sellers actually don't like accepting FHAs. But if your house is in good condition, it doesn't matter. You won't get anything wrong with the house. I've done so many transactions where there's no changes. They didn't have to change anything, the paint, the roof, or anything. Like, it was fine. So it's kind of like the luck of the draw. But now that I know as a listing agent, when you see something wrong with the house, you should let your seller know that, hey, if we get an FHA buyer, this might happen.
Yeah. Because the one thing to remember about FHA is they're easier on the borrower. Like the requirements are less strict, but it's harder on the house. They want to make sure the house is in good condition, basically.
And that's why I actually love it for buyers, because you get all this protection and help from the government, but I hate it for the sellers. So Justin, if you're going to buy your first home soon, FHA, it's a great way for you to go. So you can do FHA with 20% down.
We can do 20% down. We can do if you do more than 10% down, your mortgage insurance monthly is less. Instead of 0.85, it'll be 0.80. But it's always going to be mortgage insurance. And one other pros why people go FHA is the debt to income ratio. Basically, a conventional maximum is like 49.99. Like that's the max. With FHA, we can go all the way up to 57%.
Wow.
Yeah. So some people that have lesser, they make less money, but they want to get into a house, it helps them get into a house.
So no matter what program that you put people on, you always use DTI calculations, right?
Yes. We always use these to make sure it's not like before the crash where you're a janitor saying come inside. You're like, I make $200,000. Okay, sign here. Right.
Whoa.
We verify everything. We want to make sure that you qualify for it and that you're comfortable with the payment and everything. So
You just brought something up that was pretty good. A lot of people are saying real estate market is crashing. It's gonna crash. We're gonna see it. We're in a recession. It's gonna crash this year. I'm waiting. I'm not gonna buy a house until it crashes. It's gonna be like 2008. We've seen it before. And because you just brought up the DTI thing, we are not gonna be in a crash like 2008.
a lot of regulations came out of that crash.
Yep.
A lot.
So the reason why we crashed in 2008 is because
Wild West.
there were banks like do you guys remember Washington Mutual?
Washington Mutual.
They were giving out loans like crazy.
Yeah.
This bank doesn't exist anymore, probably because of what they did.
They got bought out. They almost got bankrupt, and then JP Morgan Chase came in and bought them out.
Right. So now we have
Last
Chase.
minute. But they paid a lot.
Basically, anyone who wanted to buy a home, they were giving a loan out.
Yeah.
They didn't care how much debt you had. And then these homes would foreclose because obviously people didn't qualify.
Yeah.
So because of that, they fixed these regulations and created these new laws and things like that for the lending side. And that's why we won't have that crash anymore, because it's been filtered to where people can't, if you don't qualify, you're not getting a home.
Yeah.
We're not going to have that crash. So it's a lot different. Also, the inventory levels are way different right now. We're still at a very historically low inventory situation where there's not enough homes for sale. So the demand is still there, even if the rates are high.
Yep.
So crash will not happen if you're waiting for it. And hey, I'm not an expert in crashes. I just can tell you by my experience. But let's say for some reason there's a World War III and all these other things happen, COVID 2, and there is a crash. Okay? If there is a crash and you've been waiting, you might not qualify anymore.
Yeah.
Because
you don't have a job.
You don't have a job, or some other new regulations just start happening with the loans, or the rates are really high. Who knows? But you might not qualify if you keep waiting.
A lot of banks were gone after that crash. A lot of bad lending practices on both sides, on the people, the consumer, because they were taking advantage of it, and on the bank side because they're greedy and they wanted to make money. I knew people that were working in Washington Mutual at the time. They would stay after hours work approving loans at the desk themselves, just approving. Like it doesn't matter. We didn't check if you. It didn't cop to their question. This janitor is making $200,000 a year. All right, no problem. Here you go. You can have the house.
Were they doing that also for investment rates? If I wanted to buy all these rentals,
Is there a whole bunch of everything?
oh my gosh,
Like,
we should have.
those-
What were we doing? Why didn't you hit me up?
I wasn't a lender back then. I was in investment
my
banking,
God.
but that was the problem. So what it was, they were lending under prime, right? In the hopes that the person that's working, or the janitor, will make more money, right? House prices will go up, and that when the rates are come due, when it pops up, it's like an arm kind of type of thing.
Right.
So it'll jump up to like 5%. Now your $1,500 monthly payment is 4 Gs, right? Now, you can't afford it no more. That's why a lot of foreclosures happened. A lot of banks went under because they sold these bad loans. But it was just a perfect storm, and a lot of regulations came out of that. A lot of regulations came out of that. So we don't see that happening. I mean, anything can happen, but it'll be much, much more difficult now to do that.
So for me and you, FHA programs are pretty much our number one type of loans that we do.
Like we talk to every client, and I give them all the options, and I break down the benefits, the cost, the monthly budget, and what's the difference between the two loans, what the pros and cons are, and we kind of decide together. Like I just don't push you towards the FHA unless you have horrible credit or anything like that. I will still give you both options, and you kind of decide like, okay, FHA might be better.
Yeah.
You know what's weird to me is that people who have never dealt with FHAs, whether they're an agent or a lender, they frown upon it. And they're like, oh, I'll never touch an FHA.
Yeah, I have
and
lenders
then
that do that.
When I work with my FHA clients, they're so happy that they have a home. And I'm so happy that I helped them.
Yep.
And so are you.
Why do they say that?
Maybe they're snobby? I don't know.
Snobby in what sense? Like there's not much money
It's just
making
more stuff
opportunity,
that-
or
Right.
Yeah.
Because, there's a certain limit to what they can loan.
I see.
And
Like
so your purchase
restrictions
price
and
of the
stuff,
home
yeah.
can
I see.
only be so much.
Mhm.
So they're just like, I'll never touch an FHA. And it's because they're making $1 million homes.
Just extra, a little bit extra work on our end.
Yeah, there's extra work. Exactly. That's what it is. Actually, is there's a lot of lazy people out there, and they don't want to deal with the extra work. And it's not about that. It's about helping someone.
Correct.
You know what I mean? Like, I don't care how much work it is, dude. Like, if I can get you something good that you'll be happy with, and then eventually make money off it, let's do it. I don't care how much work it is. Let's go.
It's a good way in. For some people get into the house.
Yeah.
We have clients that had bad credit. They thought they would never get a house, and we got them in.
Yeah.
And got them in, and then now like they're happy, and then they're just doing a refinance in a couple of years or a year.
Yeah.
And they're in the house. They're happy. They're not worried about someone raising the rent every month or every year. You know what I mean?
Yeah.
But yeah, it helps. It helps a lot of people, and in all different scenarios. So we will sit down and kind of look at it and talk about it.
How much money do your clients usually start off with?
What do you mean by how much money?
Like when they're coming into like looking for a home.
Like down for down payment.
Yeah,
and
down
stuff?
payment.
They usually have anywhere between like 10,000 to like the lowest. I think 10,000 to 25,000. We want to see about that range.
What are they buying with $10,000? Is this including closing costs?
That's not including closing. Well, that's why we have Ant here. That's going to help us with the seller's credits now. But usually about 25,000 we want to see.
Yes.
Now, but these funds can come from if you're fortunate enough to have parents that can give you some money. That if you have a 401k, you can pull money from that if you want to buy a house.
So bottom line is you need about $25,000 to buy a home.
Yep.
Because you need a down payment and you need closing costs. Closing costs, like you can't get away from that.
Yep.
Unless you're in the market today and the seller will help you pay for the closing costs, which I have been getting done on all of my last deals.
Yep.
So
good ones.
Actually, right now you can buy a home with $10K. We haven't tried it yet, but we can.
We can because of the closing costs. But we want to see, as a lender, we want to see that you have that in your bank, just in case you don't get the closing costs, right? Right. But then you just want to have that in the back of your mind. So if you had like a retirement account, like a 401k with money in it, we can kind of use that as collateral. Like, oh, he has the assets to do it. But if you have a good agent like Ant who'll get you some seller's credit, that will cover most of the closing costs.
What I love working with William about is that he always paints the worst case scenario. So even though we can probably get a home for $10K, he's like, we need to see if you have $25K in case something was to happen. You know what I mean? And I love that about him because you got to paint the worst case scenario,
Some people don't like that. Some people get scared, but I'm like, look, I'd rather give you the worst case scenario up front because it's a lot easier to give you good news. Like, hey, guess what? It's costing a lot less than we predicted, right? It's easier to go down in numbers than go up in numbers, right? So when you get into escrows, that's why you have to be careful. Some lenders, they'll promise you all these things, and then once you get into contract, and then the timeline ticks, right? You're gonna run out of time to switch lenders, and now you're stuck. Now they can do whatever they want. Now the rate's a little higher.
Yeah.
Sorry, that was a different rate when I quoted you, right? Yeah.
Do FHAs have? They're all 30-year loans. Do they have 15-year FHAs? They don't, right?
Yeah. Good question. I think that it's usually 30 years.
I think it's all 30 years. I've never seen anyone ever do
I
a 15-year FHA.
I haven't had anyone yet ask me about less than 30 years because most of the reason why we use FHA is to save money every month.
Right. Yeah. Because if you had to pay double on a 15-year, it's like, why would you do an FHA?
Yeah.
It doesn't make sense. You would just use it for a higher down payment and So now going into conventional loans, 15 years, 30 years, this is pretty much, I would say, the most used program.
Yep.
For any seasoned homeowner or even
loan officer or
officer,
agent.
right?
Yeah, it's just conventional, straightforward. Client has good credit, easy income, W-2, just a straightforward loan.
That's what I did for my first house. Yeah. I didn't go FHA on my first one. I did conventional loan, and I put 20% down. That's what everyone usually does because you can avoid that PMI.
Yeah.
So, if you don't have to spend extra money and pay extra fees, don't.
Yeah.
Right. And that's why conventional loans are the best. That's why people always say, hey, how come everyone always does 20% down? It's because of this reason.
Yeah.
But not many people have that.
Yeah. But if you have good credit and you want to save more capital, it's okay to go less than 20%, in my opinion, because
you can buy a business.
Yeah. Because your PMI, your PMI will be low. Like I've seen some as low as like $60 a month.
What?
Right? Yeah, just for mortgage insurance because you have excellent credit.
Have
Yeah,
you seen
I'd rather
someone
do
do
that.
an FHA and then buy a Porsche because they wanted to save money for a Porsche?
No, no, no.
I feel like that's something I would do.
No, don't do that.
I know,
everyone.
I know,
Don't
but
Don't do
that.
that. Don't do that.
So, there's other people that do other things though that are similar to that. Where if they own a house, they'll do a cash out refi or a HELOC to buy that Porsche.
Yeah.
How often do you work with these HELOCs and cash out refinances?
Often, because a lot of people, especially when there's a lot of equity, house prices go up, right? You can use the equity between that, between your loan and your value of your home, and pull money out. A lot of people do different things with it.
Is it hard to qualify for that?
It's the same process, right? A little bit easier, but same, right? You still have to show income. You still got to show that you can make the payments, right? Because we still calculate that loan against you, and there's still some kind of appraisal, right?
Justin is always talking to me about, hey, have you heard about foreclosures and buying homes on short sales? He's always talking about trying to get a deal for his first house. And this is where it would be really beneficial for you, Justin, if you were to get a home on a deal. And we're talking about, because you've been showing me homes that's like 200, 400K less than what it's worth.
Yeah.
You can immediately take out cash out refi or HELOC and use that for something else. Is that true?
Technically, yes, but sometimes to buy those houses, they don't take certain type of loans, like foreclosed loans and stuff. The banks are pretty specific on what they will accept.
You mean if he bought a foreclosed home?
Yeah,
you
because that bank has to approve it too.
It's not a conventional loan.
It has to be conventional loan or
Okay.
it could be
cash,
conventional loan
no?
or cash, mostly
Yeah.
cash.
So-
mostly
Mostly
that's
just
what I've been
cash.
seeing. Mostly cash.
Because
I'm like, bro, I can never buy a house like this.
So if it is cash, then that means he can get whatever loan he wants after that, right?
yes, so that's where these special loans come in.
Special loan.
Yeah, so they're called hard money loans, right? Hard money loans or
Like investors?
Yeah, for investors, right? So hard money loans and crowdfunding loans, right? They're a little bit different. They're non-traditional. I don't do it myself, but I broker it out. I know people that will do it for you.
Yeah.
And these are for investors for short term, right? When you need cash up front, and then for like, let's say investors, right? House flippers, right?
Right.
So a hard money loan is a short term loan from a private investor. Let's just say I'm a really rich guy and I have my own company and I specialize in just investing in these loans. We'll look at the value, I'll appraise it. I'll lend you cash, straight out cash. And the rate's usually high, usually about 12%, right? But in short term, maybe from 12 months to 24 months. But the purpose of this is for you to get the house, fix it up, flip it, and sell it for more what it's worth, pay back the loan, and make some income.
Why can't you do that with a conventional loan?
It's because the type of house. Usually, sometimes some like the foreclosed one. Yeah.
Oh,
Yeah.
I see. So if he was doing an auction on a foreclosed
yeah.
home and Justin was like, hey, I need to find 200K so I can pay cash
Yeah.
on this auction, you're going to give him that 200K cash
Yep.
at a 10% rate
Yep.
so you can make some money.
Yep.
And then he's going to flip it after
Yep.
fixing
Yep.
it up.
Or another
Oh,
one is someone I had a client recently where they bought the house,
Yeah.
right, and they started remodel, but they ran out of money,
Yeah.
right. So they want to do a cash out refi. The problem is without the remodel, the house is only worth $600,000. But with the remodel, the house is worth $1 million.
Whoa.
But with
That's
a,
crazy.
Yeah, with a conventional refi, we can't do it because your house is gutted.
Yeah.
It's going to be $600,000. So hard money loan, that's where the hard money loan comes in, right? They'll lend you the money. They'll look at the project. Okay, your house is going to be worth $1 million. This is worth investing. They'll give you the money. You use the money. You fix it up, and then you sell the house now the house value is $1 million. You sell the house. You pay back the money. You make profit.
I've started following a Facebook group and this guy named Pace Morby. Have you guys heard of him?
No.
He's got a lot of following. He's done a lot of coaching. He's pretty out there right now. But he promotes something called Sub2 and also something called Gator Lending. Gator Lending, it sounds easy to do. So basically, there's people who wholesale homes. And if you guys don't know what wholesaling a home is, it means that, let's say I'm a wholesaler. And I call some random guy who owns a house and I say, hey, I'm going to buy your house for $300,000. You want to sell it to me? And he goes, sure. And then I go to Justin, who's a buyer, and I say, hey, Justin, I got this home. It's a pretty good deal. It's worth $400, but I'll give it to you for $350. And really, I'm buying it for $300. So I'm wholesaling it to you.
You're just selling the contract.
and I'm selling the contract for 50 grand, but I got to get it in an EMD situation. I got to put a deposit down on it, but I don't have any money. It's my first deal. So now they're going to ask for a Gator lender to give me that, maybe $3,000 to put that deposit down. And once we're in escrow and it flips, I'll give you your money back plus interest. So there's people who do Gator lending. Within 30 days, they'll get their money back. And that's become very, very popular right now and the easiest way to make money. I haven't done it because usually it's just strangers interacting with strangers.
Yeah.
And I don't trust how I'm going to get my money back, even though it's all done in escrow. And I don't know. It's good, shady, it's weird. I don't know.
That's the biggest. I think the biggest difference between like hard money loans and crowdfunding.
Right.
Because hard money loans, they're usually like a mortgage. There is a mortgage company that deals with it only directly.
Yeah.
So they're the ones that build your loan. They work with you, and then they package the loan, that loan, and they put it onto their official investor site, and then the investor buys it.
What happens if Justin can't pay you back?
They use the house as collateral. So hard money loan, they use the house as collateral. Take the house.
Okay, but he didn't pay for the house. You did.
Oh, the contract? Oh, yeah. I don't know how that works.
You know what I'm saying?
Yeah.
Yeah, that's interesting.
That just
what
opens
happens?
the whole. Yeah, that opens a whole new.
What do they take from him? His car?
Yeah, I don't
Okay,
know.
fine.
I'll just run to Spain.
take
or
my
something.
car.
Yeah,
I mean, it's worth nothing compared to what I just made,
true.
right?
Yeah, that's kind of crazy.
Yeah, that's crazy. I haven't dealt with that, but that's. I mean, a lot of wealthy people they use other people's money to make money.
Is this why crowdfunding is a little different? What is crowdfunding?
Crowdfunding is like you sell to like individual investors, like you put it up in a forum. This is to say like
Okay,
an
like a
example,
Facebook group?
like a Facebook group, and then this is my project. This is how much it's going to cost.
Yeah.
And then a lot of times there's no collateral. They don't use your house as collateral. They show the project, and small investors like some, they'll go, okay, I'll put in 10,000, and then just crowdfund until you reach your goal. It's kind of like a GoFundMe.
I have seen that
Yeah.
in the Facebook groups where people say, I have this deal. Who wants in? And there's like 30 comments
Yep.
saying, me. Because there's just a lot of rich people in the forums for some reason.
Yep.
But they do have third-party companies where they send them money to, and then the money goes to, the escrow.
Yeah. So it's a little different and more impersonal because you're just dealing with a whole bunch of people. While like hard money loan, it's actually like they're actual lenders, right? That's dealing with it, and then an actual investor they deal with directly. And that's a lot of investors like certain groups of certain mortgage companies that deal with all the time. So you have that relationship. It's good for investors, like because then when you buy another one, this investor already knows you. Like, okay, this guy's good.
Yeah.
It'll be quicker funding. Somebody's funding hard money loan fundings 7 days.
But
Yeah, it's crazy.
Wow.
But you have to make sure. You have to make sure you can pay it back because after 12 months, it's a balloon payment. Makes you have to pay back the full amount.
yeah,
Yeah.
So I have a question for you, William. Since I moved from LA to Vegas, and a lot of people who are moving to Vegas are actually from out of state, and a lot of people they either have a home that they have right now, or when they're moving here and they don't have a job in Vegas just yet, and so they don't qualify for a primary rate, to buy their home here. They got to buy the home as like a second rate.
Yep.
I had specifically, there's a client that owns a house in California. He doesn't want to sell it. He just wants to rent it out, and he wants to buy a home here. And he can't buy it, even though he's going to live in it. He can't buy the home on a primary rate. He has to buy it as if he was going to rent it out. Is that pretty normal right now?
It's pretty normal, but it's also permanent. It's pretty normal because for us as a conventional, as a traditional mortgage lender, right, a direct lender with traditional loans, regulation shows like if you're moving to a different state, we have to make sure that you can make the money that you're making continues, right?
Mm-hmm.
So
What do you mean it continues?
Continues. So basically, if you're working in California at a hospital, and you move to you're saying you don't move to Las Vegas, how you can commute to work? It's a 4-hour drive. You can't.
Right.
So that's why we can't use that income. That's why you can't qualify. Now,
So what do people who are trying to move here from out of state, how do they buy a home?
if they work remotely,
Okay.
that's the biggest. If you can buy a home if you don't work remotely, but it'll be investment property rate or second home rate, which is a lot higher, but it might be worth it. if you want to move there and then refi. There's a couple options. So the first option is to use the second rate is going to be high. You move here, find another job, and then refinance, right? And then we'll refinance to a primary home. For like 6 months, you have to pay the higher rate. If you can afford it, that's great. If that's your main goal is to move here, that's an option. The other option is to have a remote job where you're working and verify that you work fully remote. That means you can work anywhere.
I feel like that's a lot easier nowadays since
everyone's
COVID.
working.
Yeah, since COVID.
A lot of people are working
Yep.
remote.
Yeah.
But what sucks is that I've dealt with this personally because I have clients who do work remote, but only because of COVID. So when they got their job years ago, they were working in the office. And now they're working from home and they're telling lenders like, hey, I work from home. Like, why can't I move to another state? But that's not what it says on your paperwork.
Yeah, your employer has to verify, because we verify everything. So your employer has to, because we do a verification of employment. So your employer has to say yes, he works fully remote, and that means we can use you as a primary rate.
And the problem is the employers are saying, sorry, he does not work remote, even though these people have been working from home for the last 2 to 3 years.
Yeah,
and it
that's unfortunate.
sucks.
How does it work for contractors? Like
You are working remote.
yeah, it's all fully remote, I guess.
You are fully remote.
Fully remote depends on your field and everything. So it gets complicated when you're a contractor.
Yeah.
So like like for Justin, he's a photographer and a videographer who's frequent to LA. He even goes to Texas sometimes and things like that. And he's an independent contractor.
So a lot easier to prove because you like, for example, we have a bar that we can say, we say that he told us that he wanted to buy in Vegas. He lives here in Vegas, but for the rest during the weekdays he works in California, right? And he stays there with family. So with that situation, we can use it as a primary home because he's technically not living in California. He's just there, staying at the family's house, working there, and coming home to his primary home on weekends. And that's usually a normal situation for a lot of people. People that drive from San Diego to LA every day.
So
right?
As a realtor, I don't deal with any of the loan parts or the lending side because I let the professional handle that. And we had one client who was from Minnesota, who works remote. How did you get him a primary rate? And this guy's from Minnesota. It's not like he works out here, right? How did you prove it?
Because he worked remotely. So I think he worked remotely and his partner worked at a hospital. But as long as one of them worked remotely, right? Actually, his partner was staying there. But as long as we can prove that he works fully remote, that's all we need. If your employer says you work fully remote, you can buy a primary here because it makes sense, right? So it makes sense for you. You still work the same job because you work remote. It doesn't matter where you work. You can be working in Hawaii and Island working.
Aren't all independent contractors remote?
Depends. Yeah, technically yes, but it depends on the job. It has to
make sense. I get what you're saying.
It has to be the story, right? It has to paint a correct story, right?
Right.
I get it because me and Justin and Mr. Minnesota, we do work at a home office.
Yeah.
That means we can do it anywhere in the world, right? So we are working remote. But if you're an independent contractor, let's say you are a pool installer, and you're an independent contractor that gets subcontracted or something like that, well, they only work in a specific area, right? So they're not working remote.
It's just basically how I can prove that you are not stuck in your job is not
stuck
in California
in one area?
only. Yeah, stuck in one area. Like you can go anywhere you want.
So let me clarify a little bit. That was a little.
So it's a little tricky. That's a little tricky scenario. That's when we have to really dig in and kind of like. That's when it's good to have it work with a direct lender like myself, where we talk directly to our underwriters. Go, hey, this is a situation. Like, what do you think? And they're more of an expert than I am.
So here's another situation. So you can't be an independent contractor pool installer company, but you can be a worker for the company as an independent contractor. And so maybe that company could hire you in Vegas to help them install a pool.
Yeah.
And then someone else in Texas can call you and be like, hey, I need your help to install this pool.
As long as your employee, as long as we can explain that you're not stuck at the main office, right? Like, this is your main office, but however, I work mostly here. I travel a lot, but I would spend most of the time here. It's a scenario by scenario basis, basically.
What are some common mistakes or things that you see freelancers do as far as like paying themselves or whatever that affect
Write-offs.
write-offs?
Yeah, because
That affect their loans, I guess.
yeah, write-offs.
If you write everything off, which is great because you don't pay taxes, it shows a lot of loss in your income. So then because you're paying a lot of taxes and there's lots of income, it shows that
You don't make money.
you're not making any money.
So it's all about
You don't qualify for a loan.
If you're a 1099er business and you're planning to buy a house, my recommendation is for the next 2 years, because we look at 2 years. Next 2 years, you got to pay your taxes. Just show as much money as you can, and then pay those taxes. So because your plan is to buy a house, so you're paying those taxes to buy a house. So that when I calculate your income for business and independent contractors, I average about 24 months of your income. So you don't want to. We don't want to see a decrease. We want to see an increase.
Like I've been self-employed for the last 10 years, Justin, and I write off a lot of stuff as I can because I go on a lot of places. I go on a lot of business meals. I do everything legitly, right? Mm-hmm. And so there's a lot of write-offs. But the years I know I'm about to buy a house, I tell my tax guy, you know what? Let's just not write off as much because I want to be able to get a loan. And so that hurts me in the end because even though I'm on a business meal with William, I tell my tax guy, you know what? Let's not write this business meal off because I got to show that,
You have to show you have money.
Exactly.
You're making money.
Mm-hmm.
Yeah.
Another question that I had is, I know there's like different ways to pay yourself from your business. You could do a payroll or you could do like a owner's draw kind of thing.
Yep.
Right.
Do you ever consider like the business and the person's income the same? Like, or I don't know if that question makes sense.
Yeah. So I have a cousin of mine. He is a doctor.
Mm-hmm.
He has a LLC. So what happens is all the money he makes as a doctor goes into the LLC,
Mm-hmm.
and the LLC pays money to him,
Mm-hmm.
right? So on paper, when I do calculation, it shows every year he pays himself like $100,000. That's good because I can use that $100,000 solid because
Mm-hmm.
that's a W-2,
Right.
right? But we also we use both, and then we have to look at the business and see if he takes any hits, like any write-offs.
Mm-hmm.
So we balance that out. But the $100,000 solid helps because it shows that it just pays him.
So you can use his $100,000 that he makes because he pays himself that.
Yeah, mm-hmm.
And let's say his office made $1 million,
Yep.
and he has $300,000 in write-off, so there's $700,000 left. Can you use that?
Yeah. So as long as there's no negative, you should be fine.
Okay.
But negatives, and the negatives are what hurts you. And when those are the scenarios where you need to get a loan officer because it gets pretty complicated. It's not as straightforward like W-2. It's like a conventional W-2. I just look in your pay stubs, your debt, easy. With business, we have to look at everything. Your write-offs, your year-to-date profit loss, 24 months. Like we have to look at everything.
Yeah, and I know some people they might make this mistake. I don't know if it's a mistake or what, but they might not pay themselves out of their business. They might just use their business account for everything. Is that a bad thing to do? Because now you don't show any income or.
So, the best person to ask is your CPA.
Got it.
But for my, if I'm doing the loan, then I would just look at your business. So,
Oh, really?
so
Okay.
everything, whatever you report on your taxes.
Got it.
So that's
Okay.
when the write-offs, right?
Yeah.
So you don't pay yourself. So I just go off the business. So if your business is negative, then you're in the negative.
Yeah.
But if your business is positive, then I can calculate the 24 months.
I've kind of done it all.
And some loans don't require me to review 12 months. So it depends.
Okay.
There's times where I don't pay myself because I don't make that much money self-employed.
Yeah.
That's why I have like 6 different gigs.
Mm-hmm.
But the years I don't pay myself, I still qualify for a home. And then when I don't qualify for a home, the lender will tell me what that I don't qualify, and I'll ask my tax guy, what do I need to do? Because I need to show that I can qualify for a home. And he goes, well, if you haven't been paying yourself, what we can do is pay yourself at the end of the year. So you can pay yourself like in one lump sum, 20 grand, or 24 grand, which is going to be like $2,000 a month type of thing.
Yeah.
Right? So there's different ways. It just depends on your situation.
Yeah, situation.
Now, can you buy a home through your business?
No,
That was a great question.
that was a good question.
But what if the
It's a complicated question, but technically no, because the loan when you buy a home, you have to qualify conventionally. You have to qualify as like everything goes under your person. Only the person can be on the loan, mortgage loan, right? Title wise, you can once you buy the home, you can put the title under the business. That's what a lot of investors do. They'll buy the home under their name, and once the home is closed, they put the title under the business.
Now,
Interesting.
I think Justin was asking for his photography business that he owns. Can he buy a home with that? And you're saying no.
No.
Now, if I
To
started
qualify for a loan, I cannot say XY business is buying this house. It has to be a person.
Really?
Yeah.
And what if I was an investor, as a guy who is wanting to rent a house, buy a home for rental, with a bunch of buddies, and we want to start this LLC like Homies Buy Homes LLC, and Homies Buy Homes want to buy this house with the LLC. You're still saying no?
Yes, it has to be. Remember, we tried to do this before a long time ago. But
I don't remember.
Yeah, we tried to do it before. We're not naming any names, but we tried to do it before. It has to be individual for a conventional residential purchase. It has to be individuals, right? It can be 4 individuals. I can do that, and it'll be under all your four people's names. But then the title, we can once the house is bought, we can move the title into the LLC.
Like house is paid off? Is that what that means?
No, that means the loan is under the people's name, but on title. It's under the business.
I see.
Yeah.
So it's two different things. There's
The records,
people who are responsible for paying the
loan.
mortgage, which is the loan, and
You
then
own the
there's
house.
people who are responsible for
They own the house.
they own the house.
I feel like I've been seeing a lot of things like, oh, you should be buying a house under your LLC or something. And I'm like, I don't know what that means really. So you can't really do that? It's just...
You can't... I'm not saying you can't do it, but you can't get a residential mortgage conventional loan.
Got it.
I mean, there's commercial loans, but that's more... If you have... It's more than 4 units.
I see.
Right? And then that's when you go kind of get into the business side of it. And there's business loans too. I kind of specialize in that too. But as a personal mortgage residential, it has to be an actual person to qualify for the loan. Yeah.
And then... do I have to buy my own personal home first before I can buy an investment property?
No. You can buy investment property anytime.
Hey, so I have a question. Let's say Justin wants to buy a rental property first, right? Is that a primary rate or an investment rate?
Investment rate.
Okay, and then now after,
well, unless you work remotely, that gets kind of over there. But yes, it has to be investment rate because you buy it as investment property.
Okay, and so let's say he's had this rental for a year and is cash flowing some money, right? He's a landlord.
Yeah.
And now he wants to buy a home for himself. Now, does he qualify for an FHA?
Yes, because it's not a primary.
Whoa. Okay.
It's primary home that you care about. So it will ask you to have you own a primary home. And FHA, it's not for the first, like, as long as you don't own a home. You know what? Let me double check that. Yeah. But I know as long as you don't own a home within 3 years, you can qualify for FHA.
Every 3 years, you can qualify for an FHA if you haven't owned a home.
Yeah.
So what I meant, let me clear that up. That was really messy.
Yeah.
So let's say you bought a home for your first time and it's FHA, and then you decide to sell the home and move with your parents because for some reason you just want to live with your parents, and you live with them for 3 more years, and you want to buy a home again. Now you're starting over as a first-time home buyer. You could do an FHA again.
Yeah.
So you're also saying that I can buy an investment property first?
Yes.
And then...
You can do that.
Okay.
Because the cool thing about investment property is that we can use the potential income for that property to help you qualify. So like, let's say you make X amount of money, but then when we buy an investment property, we can use the appraisal, the potential rents from that property to help qualify for the loan. The rate's higher, but that's the benefit though. We can help use the potential income from that property to kind of help with your qualifying. And then when you buy your own house, we can use that, because then most of the time you say you have a house now. Let's say you have a primary now, and you want to move to another house. We have to count that debt against you, right? But let's say you're 2 ways around that. If you show that you're gonna rent this house and you have someone that's gonna lease it already, and we just need the lease agreement, so it'll cancel out that loan, right? Because someone's going to rent it already. And then now when we buy another house, we can use your full income without counting the mortgage against you. And of course, when you buy your investment property, you can use the potential rent for that too. So
Now, do FHAs work for multifamily homes?
FHA, multifamily homes, like how many, like?
Or I guess like a duplex kind of thing?
No.
Okay.
Oh, duplex.
For an FHA,
I don't, maybe I'm tripping, but I've been seeing that too on
I think
it's like use your FHA to buy.
I think up to 4 units. I think. Let me come back to that.
Yeah,
I have to double check that one.
I do know that you can do ADUs, so you can buy a home with the FHA program, and you can convert the garage into an additional dwelling unit, which is an ADU. So now your garage is converted into a studio or a 1-bedroom house on the same lot. You can do that. That's for sure. Yeah.
I don't know if I've been seeing that in Vegas. Is that even allowed in Vegas?
You don't see that in Vegas because you don't have too many detached homes, and that's the perfect scenario for an ADU. Because in LA, when you have detached garages, they have the private entrance. They got a side gate, so you can really separate, the tenant and landlord situation. But in Vegas, you guys have like 3-car garages attached to the home, stuff like that.
Yeah.
What I do see though is there's luxury homes with casitas.
Yeah.
Okay. That's cool. But if you want to do the garage thing, I've seen them where they have 4-car garages, 2-car garage on one side, 2-car garage on the other side, and 1 2-car garage is turned into a Gen Z lounge. And, you can do that. So there's different things.
FHA multiple units. I have to come back to that because not a lot of FHA buyers buy.
Yeah,
multiple
I was
units.
just curious.
But I think
Yeah.
there should be. On top of my head right now, I can't remember. I'm pretty sure there is.
Yeah.
I'm going to say that you probably can't because when you buy a multi-unit, it's a lot of money. You're talking about $1 million.
Yeah.
Okay. And you can't buy a home with an FHA for $1 million. No. You're capped out at like $600,000 to $700,000.
So anything over the conventional limits, it's called a jumbo loan.
Got it.
And jumbo loans are in private investors as well, and they have different regulations.
Yeah, I feel like there's a lot of crazy information on social media right now.
You can't trust everything in social media.
No, for sure. It's just it makes people believe a lot of stuff, and they try to like move into certain loans really fast or whatever without getting the right education. Yeah. And it puts them in a bad position.
I always recommend doing research.
Yeah.
And research. Even when you listen to us, do multiple research and just the most trustworthy research and look up government's websites and look through that.
Now, I also, again, social media kind of thing. I've also heard like people, like let's say you're a couple and you're not married yet or whatever. One person does the FHA 1 year or whatever. They live in that house, and then the other person does an FHA and lives in that house after that or whatever. Is that typical, or is that kind of a mess, or
in a mess in terms of what?
Because
if you guys decide to live in separate homes, that's fine.
More so like, okay, you guys live in that house for 2 years and then you use her FHA to live in another house the next 2 years.
What are you doing with the first house? That's
renting it out.
Well, technically, if you're not on the loan, right? That's a special scenario.
Yeah, I'm literally speaking off of social media stuff. You know what I mean?
Because you're not married. Technically, because you're not married, then yes, you can kind of do that because you're not married.
Right.
Because there's no reason why you're living. Like I'm living somewhere else.
Yeah.
We're not married.
Yeah.
Then yes, you can use our own FHA program.
I can say that yes, you can do that, which is why social media is saying go do that.
Is it smart?
Yes, it's smart in terms of for you financially,
but it's kind of gaming the system.
You
don't want to get in trouble.
Knowingly doing that is a fraud. And now the government is going to come for you.
You don't want that.
And that's way worse.
Okay, so people are really getting messed up on this social media type of stuff.
Yeah, you're doing things illegally because it's known for that. So
it's got to be. That's it's that gray line, right?
Yeah.
It's like a really gray line. Like you know you're not supposed to be doing that, but because technically you're not married, like it's. I don't recommend doing it.
Yeah, of course.
But I mean,
so before you follow these Instagram tips, make sure you do your research.
Yeah,
Guys.
yeah.
Like, this is crazy.
Yeah, don't believe everything you
Yeah.
guys hear.
Because people find a gray area and like you could do it,
Yeah,
but
yeah,
it's really a gray area because you
Sometimes your agents don't even know. You know, like when you're buying a home, you might have an agent that, you know, let's say you're looking at this home and Justin, you're like, hey, agent, how come, you know, this AC unit is all rusty and it looks like it's about to break? And then you guys turn it on and it's making all these humming sounds and you're like, oh, crap. It doesn't even put out heat, you know, like it's broken. And so there's some agents that say, you know what? Don't worry about it. If we don't get any repairs done with the house, you can just hit up your home warranty and they'll fix it. And all you gotta pay is $75 service fee, and they'll replace a whole new unit for you for free. And that is fraud. You know, and agents don't know that because I don't know, they just haven't done enough experience. But basically, if you know that there was something wrong with it and you want to file a claim, then that is fraud. And that goes the same way with trying to buy one FHA to another FHA.
I see.
You know, it depends on what you're trying to do with it.
It's always do your research. Even us, like I've been doing it a long time. I've been in the financial industry for over 15 years. Like not everyone knows everything, and especially if we deal with so many types of loan. Like when you asked me that multiple family FHA, on top of my head, I can't remember, but I will promise you that we will find the right answer.
Yeah.
I'm not going to just BS.
Of course. Yeah.
So
yeah, I mean, if you can find a duplex for under 700, then yeah, you can.
Yeah. So
it.
but yeah, we'll always look out. Like ask this question. We'll always, if we don't know the answer on top of our head, we'll find out. We'll use our resources too. But yeah, don't trust anything in social media. Even just do your research. Make sure you do your research.
Cool. Let's move on to some questions.
Yeah.
Yep.
We're kind of
Q&As.
running a little late on this, but we'll go right into it. I don't understand some of this stuff, but you guys are experts. Why do underwriters keep asking me for the same documents that I've already sent?
Yes, William. Why?
So being underwriters, we battle a lot. So the underwriter's job is to make sure that you qualify for the loan, right?
Well,
so
first, who is the underwriter?
the underwriter is the person that reviews all the documents I give. I do all the calculations I put in. I repackage it really nice. We send it to underwriter. They're the ones to make sure that they read all the guidelines, whatever program we're using, every single restriction, and make sure that this loan passes all of that. So if they're asking me for the same document, there's something missing. It's either not clear on something, looks kind of modified. There's specific things they ask for, right? Or your job doesn't make sense. Their job is to make sure that they're protecting you and protecting the company, and then that everything falls correctly with the guidelines. So that because mortgage company, we do the loan, we approve it, we lend the money. Every mortgage company will get that loan and sell it back to the market, right? So then the Fannie Mae, Fannie Mac, they're not going to buy the loan if there's something freaky with it, and now the bank will take a hit. So they want to make sure everything follows guidelines. So if there's something gray, they will ask for it.
I don't think you can answer this question, but I'm going to ask. A lot of seasoned home buyers, they know this part, and I think that's what this guy is asking. We understand fully about gray area stuff that you guys need to get more clarified.
Yep.
But there are times when I send you my paperwork and I'm like, I just gave this to you. Why are you asking me again? And I think that's what they're saying.
Sometimes underwriters, everyone's human,
Yeah.
right? And depending on the situation, I've dealt with some underwriters can dumbasses. they can be they're human, right? They deal with a lot of files every day.
Yeah.
Right? And especially when it's a big boom, they deal with hundreds of files weekly. So they may miss something. So that's my job. That's why you have a good loan officer to fight for you. Like I already sent this in and kind of explain to the underwriter. So I will get on the phone with my underwriter and I've done this many times with our clients. Like I would have to call the underwriter directly and go, why do you need this? Like we sent this in, and I would walk them through the whole thing. And go, okay. Or something specific. Okay, what else can we use to get this done?
I do see the difference between using you as a lender and someone else. When I used someone else before, the underwriter always asked us a lot of questions, and we had to figure out reasons on how to fix it. But with you fight for it, and I never have that issue. So maybe this guy who asked the question on Instagram has a really bad lender who's not fighting for him and just letting the underwriter step all over him.
Yeah, because I hate having to call my client and go, I need this. So I'll try to fight. I'll research it, and I have a whole team. We're a good team. We research it. And we go, all right, how are we going to fight for our client for this? And then we need it. We'll ask for it, and then we'll fight in tooth and nail to get it passed.
So bottom line, reach out to William as a lender. No one else.
Can you describe exactly what a lender does?
So a lender, we make sure you qualify. We take all your documents. We make sure you qualify for the loan. We package the loan, right? We are the person that lends you the money.
Yeah.
There's no other way to borrow it. We're the lender. So a direct lender is someone like me that works for a company that we only deal with mortgages. We're the only company. We approve the loan, and we either keep the loan, and normally we service the loan too. It just stays with us, right? There are brokers where they are the middleman, right? They'll offer you a lower rate because they make more money off the loan. They have a certain percentage that they can make off, and they select multiple banks that gives the best rate for them, right, or the best deal. The only problem is they package it up, and they'll offer it's like, hey, I'll package it along. Hey, Ant, you want to buy this? Hey, what's the best rate? And they shop for you, but there's hidden fees and all those, and they can't talk to the underwriters directly, right? So there's a problem. It's going to be harder to get that fixed. While a direct lender like myself, we work it's in house. We know the people. We work with them every day. Like I said, I'll call them and like, hey, like what's going on? Like, how are we gonna get this fixed? We're all on the same team. We need to fix this.
So for every normal person who's trying to buy a home, you can't buy a home without a lender.
You have to have a lender. That's what it is. The lender is the person that lends you the money. There's no way around
that. This person asked, can I get a loan if I've only been at my new job for 4 months and was previously unemployed for 1 year? And then when can I get a loan?
So there's a little bit more information I need from that. So you can be a job for 4 months. You can be jobless for a year before that. Now, what did you do before that year of joblessness? So if you worked before that for a year or two, you should be fine. We just got to explain why. There's a missing time period. COVID. That's what happened with a lot of COVID.
Yeah.
So we have how people just finished COVID, they got a job. And I explain, it was COVID. They didn't have a job. But before COVID, they also work for another year or two, right? And if I show that history, you should be fine.
So what if you're a young kid and you've never had a job in your life, and now you just got a job for the last 4 months that was banging? Let's say, here we go. Here's a perfect scenario.
We have one.
Now, let's say there's an 18-year-old YouTuber, okay, never worked in his life. All of a sudden, he went viral, and now he's got 10 million subs on YouTube, and he's making $10,000 a month. Does he qualify for only doing YouTube for 4 months?
If it does YouTube, then it's a business owner. So business owner, we need 2 years of working history.
So he doesn't qualify.
Does not qualify.
Even though he
makes $10,000 a month, we don't have no history to back that up. So business owners, we have to have 2 years of business history, to prove that this is normal, and this will continue on. Because $10,000 a month, but we don't have history of him for 2 years. It's not stable. Right?
Even if he has like 500 G's in the bank
from his dad.
I mean, they can't. There's no way. You have to do it not conventionally. There's other loans. Other loans that we can do. It'd be higher interest.
Yeah.
Right? But conventionally, we cannot.
So TikTokers, you are screwed.
But back to that scenario, we had a scenario like that. We had a client like that. So if you went to college, you graduate from college, let's say you're a doctor, scientist, whatever, you get a good job, and say you're working at a job for 4 months, yes, you can get a loan as long as it's W-2, straight hours, because we can explain you just graduated, and now you're making $150,000 a year, a solid job. We have an explanation. You didn't have work history because you were in school.
Is it because, I mean, it's common sense. If you're going to college, you have the money to pay for tuition or student loans. Is that why they're using
No, it's because you have a solid job, and the job you're in is a W-2. It's straight 9 to 5 hours, and so it's not going to go anywhere.
I see.
Yeah.
And then last question is, how much should I put down for a $700,000 home or $800,000 home with less monthly payments as possible?
That's a loaded question.
That is a loaded question. All cash? Then you don't have any monthly payments?
Well, of course, minimum, like I said, minimum for conventional is 3%. Minimum for FHA is 3.5. If you want the lowest monthly payments possible, then the more you put down, the less the less money you pay monthly.
Okay.
So you want to avoid PMI, which is one. If you want to save money, then 20% down minimum.
Yeah, 20% would be the starting point of the lower monthly
Yes, that would
payments,
get
right?
that would get rid of the extra fee of mortgage insurance.
Anything from that point on is
It's
up to you.
and then I'll lower.
I would say anywhere from 20 to 50%.
Yeah,
You know,
50, a big difference in your monthly.
anything more than that, just buy it all cash.
Yeah. Or I mean, I have people that pay. I had a client that put down 500,000. His parents gave him.
Yeah.
But the house was like 800,000, so he bought 300.
Wow.
What?
But the rate would be better because
Yeah.
it's less risk to the bank.
Yeah.
Right? Less risk to the bank, so the rate's a little better. Your payment's gonna be less. So there are scenarios. So don't believe social media. So I have always people that be like jealous of other friends and stuff. Like, dude, they bought a house and they own it, blah blah. You do not know. Listen to everyone. You do not know what help they had, because they ain't gonna put on the social media, oh, my mom gave me $500,000 to buy this house. They're just gonna say, I bought this house.
Yeah.
Look at me. Well, you don't know that I'm the lender. I know everything. So they don't. You don't know that the mom gave him $400,000 to help him buy this house. You don't know that.
Yeah.
Right.
Yeah, there's been a lot of scenarios where I'm like, bro, how did you buy this house, my guy?
Yeah.
You know,
They won't say. They're not gonna brag. Oh, my mom gave me $500,000. Like, I did this all by myself. That's what you're gonna say. So.
Right.
I'm all getting butthurt. I'm like, bro,
Yeah,
I'm
don't-
31. Like,
Yeah.
Don't.
they have
feel
help,
it.
man.
Yeah.
Yeah.
There's a lot of help out there. So
Yeah.
Don't worry.
There's another question that I read that someone DM'd me with on Instagram. And obviously I know this question, but I'm going to ask it for everyone else out there. Do you have to get pre-approved or pre-qualified to buy a home?
Yes. Well, it's yes. It's when you go house shopping, they're gonna ask you if you present an offer to the seller, they're gonna ask, oh, what's your pre-qualification?
So, two parts to it.
Yeah.
As a realtor, yes, because I cannot submit your offer without a pre-approval letter.
Yes.
If you don't have that letter, then the seller is not going to look at you as a serious buyer,
Yep.
and they're not going to take your offer.
Correct.
So, yes, you need to get pre-approved for that reason. For the lender, what I understand is that, yes, you need to get pre-approved because let's say you don't, and we do get, for some reason, an offer accepted from a desperate seller. And in the middle of escrow, your loan doesn't get approved, and you waive some contingencies or whatnot.
Yeah.
Who knows? But your loan doesn't get approved. Well, now you're screwed, and you got to back out of escrow. You got to lose some money, all that time and effort. Everybody's mad at you. Well, if you got pre-approved in the beginning, then we wouldn't be in this situation.
Yep.
So the lender always wants to get you pre-approved first, so they don't mess up anything because maybe something with your credit history was wrong, what you told them was a lie, whatever. So yes, you need to get pre-approved.
You want to make sure what you're offering and you're ready to buy. You don't want to just fluff it and like, okay, I'm going to buy it, but you really can't afford it. You want to make sure your lender gives you the worst case scenario, like I always do, so you won't be surprised.
Yeah, you also don't want to go shop for a $1 million home knowing damn well you only afford a $300,000 home.
Yeah.
So,
dude, I'm always doing that on Zillow.
That's I see that all over Instagram right now, where people are like, this is my reaction when this $2 million home I couldn't afford just sold.
Yeah,
It's funny.
exactly.
Yeah.
You know how many houses I have saved on there that I can't afford?
Oh my gosh. All right, guys. Thank you for tuning in to the Next Win podcast. Thank you, William, for being here.
Thank you for having me.
We appreciate you. Email him. You'll see it in the description box. If you guys need a lender, get pre-approved. Tell them what states you work in.
California, Texas, Nevada, Florida, Georgia, and New Mexico.
So if you guys are looking for a home out there, we can help you out with that. I am licensed in Nevada and California, but I do know a lot of people in other states as well, so we can help you out. Justin, another great episode.
Yeah,
Thank you, sir.
Killed it.
I love it, guys. Thank you for listening. And until next time, guys, thank you for joining the Next Win podcast.